Hello, I am Ed Butowski, Managing Partner at Chapwood Investments. This presentation, which will last about 12 to 15 minutes, has one goal, and that is to show you how to properly evaluate your financial advisor and their portfolios. Been in this business for 25 years, managing some of the largest clients in the world, working at one of the largest investment firms in the world, and it shocks me on how poorly trained financial advisors are, but even more so, how difficult it is for individuals to evaluate what we do and how we do it. As I write here, the world of personal investing is flooded with a bewildering mix of half-truths and conflicts of interest, even though vast majority of the people are not equipped to really understand what we do and how we do it. There will be 4 steps towards the end of this presentation that will help you evaluate people like me. Now, to put it in perspective, we need to go back to right when the Great Depression was ending. The Glass-Steagall Act was put in place, and what it did is it separated banks from competing with brokerage firms from competing with insurance companies, and made it really silos where none of these groups and none of these industries competed with each other. This stayed in place for 66 years until the 1999 Graham-Billy Act was put in place, which literally dismantled the Glass-Steagall Act. What happened at that time? The distinction between commercial banks, brokerage firms, and insurance companies was blurred. You could literally not have a good, clear understanding of, should I go to my insurance firm to get my investments done? Should I go to my brokerage firm to do my banking? It was literally that confusing. Along with the advent of the internet, this problem became amplified because then people started thinking, should I just do this on my own? Very, very confusing time. But people didn't think much about it because at that time, the stock market was going higher. People were making tremendous amounts of money. People didn't care and didn't really pay attention to a Nobel Prize that was awarded in 1990. Harry Markowitz, Merton Miller, and William Sharpe were awarded a Nobel Prize in economics. They were awarded it for modern portfolio theory. I call this the rule book because this allows you and gives you the tools to analyze portfolios and advisors. In addition to that, around that same time, another study was done called the Determinants of Portfolio Performance, and this has been heralded throughout our industry. Very important study. It was also confirmed by Roger Ibbotson, a professor at Yale, with the Ibbotson-Kaplan study. What this showed was that 93% of the return in a portfolio and 98% of the risk was attributed to the construction or architecture of that portfolio. As I stated earlier, I've been at this business 25 years, and I can tell you without any question that none of the major investment firms teach portfolio architecture or construction in their training programs. That is right. This is not taught at those firms. To me, this is the smoking gun and one of the biggest problems in our industry. So here you'll see 4 major evaluation factors. I want to go through these in detail to help you and empower you to literally evaluate your advisor and those firms in an objective, dispassionate way. First and foremost, everyone's heard the term standard deviation. It simply measures the distribution of returns from an average. The more the spread, the higher the standard deviation, or at the same time, the risk. As a general rule, you want your standard deviation to be 60 to 70% of your historical rate of return. If that standard deviation ratio is lower, that's even better, and I'll demonstrate that to you on the next slide. Here are 3 different portfolios, all having a rate of return of 10. They all have different standard deviations. You can easily see that the one with the lower standard deviation has a better compounded rate of return from $100,000. Granted, the numbers aren't that great, but it does amplify as your portfolio becomes bigger. If you had a rate of return of 10, and you must measure these, as you can see down here on the bottom left-hand corner, you want to measure this over a 10-year time horizon. Not a 1-year, not a 2-year, but a 10-year time horizon. If you had a standard deviation of 15, what this shows is that your return, 19 out of 20 years, was between -20 and +40. So you had just as good a chance of getting a return of +40 as you did having a return of -20. Portfolio 2, the standard deviation is lower, and you can see that the spread becomes lower. 19 out of 20 years, the returns were between -2 and +22. And if you want, feel free to give me a call, and I'll show you how to measure this on your particular portfolio. And then you can see here Portfolio 3, a rate of return range between +6 and +14 with a very low standard deviation. Again, always the lower the standard deviation on the same rate of return will get you a better compounded rate of return. The next evaluation factor is called the Sharpe ratio. Everyone in our business should know exactly what the Sharpe ratio is and what the Sharpe ratio is on their portfolio. This won a Nobel Prize. Everyone talks about understanding and knowing modern portfolio theory, and William Sharpe gave us a ratio to measure how much risk are we taking for our return. As a general rule, you want your Sharpe ratio to be 1 or higher, or close to 1. That means you have a better risk-return ratio. Sharpe ratio is measured by taking your historical rate of return, subtracting your risk-free rate of return. In this case, I just put down money market. And by the way, it's not the money market today, it's the money market over the 10-year trailing period, because you should be measuring it over a 10-year period. You can do 7, but nothing shorter than 5. You can see the Sharpe ratio on that first portfolio is 0.33. So you should be able to go up to your advisor and say, what is the Sharpe ratio on my portfolio? And if he says or she says it's 0.2, you know you don't have a good portfolio. You can see the others. You want to have a Sharpe ratio close to or higher than 1. The key to asset allocation is knowing and understanding the correlation between your assets. Every investment has a correlation to another investment between +1 and -1. A properly managed portfolio should always have some investments that aren't doing well, because if everything went up during an economic period or condition, everything would go down when that economic condition changed. Here's an example of a correlation matrix. I put this chart together to show January 1990 to December 2000 is in black, and January 2001 to August 2011 is in blue. Advisors don't understand that what used to work in terms of having a low correlation just doesn't work anymore. Simply look at the Russell 1000 growth and Russell 1000 value. There's a 0.57 between 1990 and 2000. Today, it's 0.92. The S&P hasn't changed too much. The Russell 2000, which represents small stocks, absolutely does. 0.47 it used to be, now it's 0.92. And what you're seeing here is that across the board, the long-only world just doesn't get you the low correlation anymore. And a lot of advisors will build their portfolios using separately managed accounts. Every firm has them. If your portfolio or your client's portfolio has only separately managed accounts in their, as their holdings, you do not have an efficient portfolio. It is mathematically impossible to have an efficient portfolio simply using long-only managers. Now, fees. This kills me. Fees are what we call in the business negative alpha. And since 1990, which was quite a while ago, fees have dropped significantly. This can kill you, and you need to understand there's an investment fee, there's a management fee, and there's even commissions on bonds. Notice that the very first time you get a statement when a bond is purchased or sold, but mainly purchased, look on the right-hand side of your statement, and in parentheses, you'll see most likely a number in parentheses. That shows you what the advisor took as a fee. It's hidden, but it's not hidden to you if you know what to look for. Generally speaking, you should be paying about 50 basis points. That's half of 1% to have your money managed. You should not be charged anything on concentrated stock, money markets as well, and we actually don't charge on bonds. You should not be charged on bonds to have them managed. Here's a typical portfolio. Anyone would look at this portfolio and think it's a fine portfolio. 60% in U.S. equities broken down in different sectors within the equity category, fixed income, and you have some money in the international markets. So as a first glance, you'd look and go, well, I don't see anything wrong with this portfolio. However, Now let's look at the details. This portfolio over the last 10 years has a rate of return of 7, standard deviation of 9, a Sharpe of 0.56. Not a very good portfolio. And the probability of a loss at the beginning of any 12-month period was about 22%. Your range of returns, as you can see, were between -11 and +25. However, what it should look like is you should have a standard deviation of 4 if you're willing to accept a targeted rate of return of 7. Therefore, you would have a Sharpe of 1. And notice this 4 is 60% of your historical rate of return. That's what you want. Your probability of a loss at the beginning of any 12-month period drops dramatically, and your compounded rate of return increases. And here you can see a side-by-side comparison. This is what you should be doing and looking at when you're evaluating your advisor. Here are some of the major brokerage firms. These are their model portfolios. We can do this for any portfolio that you're looking at. We can come back to you with numbers to show you specifically how good these portfolios have done and what they're set up to do. Here are 4 questions that I encourage you to go and ask directly to your financial advisor. I'm going to give you the questions, and then I'm going to give you the answers. First one I call a catch-22 question. This is my favorite question. And I built these questions and made them up because I think it's important that you ask. This is the question you ask your advisor. If I had a portfolio with a historical rate of return of 10, what should my standard deviation be? In addition, what is my portfolio's historical rate of return and standard deviation? Your standard deviation in this situation should be 6 or lower. You should measure it over a 7 to 10-year time horizon. The reason I say it's a catch-22 question is if your advisor doesn't know the answer to this question, you should not be working with that person. What that person is really saying is, I don't know how much risk should be in a portfolio. If they do answer it correctly, then let's evaluate that portfolio and see if they answered it right, if they're actually doing what they said. Next, real simple, ask them what their Sharpe ratio is on your portfolio and what it should be. Ask them to send you a copy of your correlation matrix. Every advisor should have that ready to go. You can look at what the correlations are today. And again, you want to look at it over a 10-year time horizon. I'm Ed Butowski, Managing Partner at Chapwood Investments. Follow what I'm saying to you here. Evaluate your advisor. If you want me to help you, I am happy to do so. Thank you for your time.